industry particularly, that all these standards, it will be difficult to implement in India, and they have represented strongly because it's very difficult for them to predict what will be the profit. But the thing is that now again they have forgotten everything, and when again it will be introduced, again they will say that these are the standards which are difficult standards to implement. So there is no preparation which is being done by the country. So that's a sad part, but that is a way we live in India. So
you mentioned about corridor approach. What is corridor?
Corridor approach is that whatever difference which is there, that you don't take it into the income in 1 year, but you spread it over a period.
So various accounting bodies are there other than our institute. There are Chartered Accountants Association practically in every city, every major city. Even they are not representing, or they are not giving any feedback?
No, unfortunately they are not there is no comments which are coming. If you look at the changes which are done, hardly 2 or 3 comment comes, and that also nothing material.
FICCI, CII, IMC,
No, unfortunately comment doesn't come.
With the major large corporations like Tata Group, Birla Group,
it doesn't come, but it comes only afterwards. As I was mentioning, it comes later, and they go to their MCA rather than coming to institute. So what they find is that it is easy to convince MCA because they will look at the industry. The institute is looking only at the typical theoretical accounting. They are not looking at the commercial part of that. That is what industry feels.
When these seminars and conferences are held by CII and FICCI and ASSOCHAM, whether these issues are not highlighted?
It's being highlighted, so there are some improvement, but I think improvement is not what talking about. So there is some improvement which is there. Some comments are coming. RBI is quite active on financial instrument standards. So that's there. Okay, let's move to a deviation which are there from pure, which we call it as a carve-outs now. As I was mentioning, there is a deviation in the real estate development, whether percentage of completion method one needs to apply or not. So rightly, what I think our guidance note which is today, which is actually in line with IFRS 15 today, IFRIC 15. IFRIC 15 is going to get changed. So I am just saying that today it is in line with IFRIC 15, our guidance note, which basically says that you need to account on the basis of a percentage completion method only if there is a sale of that unit, and that sale of unit, risk and reward is transferred totally. If there is a doubt on transfer of a risk and reward, then you cannot book the revenue and profit. So our accounting guidance note is, I think, that way in line with IFRIC 15, which is fine. But now IFRIC 15 is getting changed, and now they are saying that in certain other cases also you need to apply only on a completion method. Then there is a major difference between foreign currency convertible bonds. A lot of companies in India have gone for FCCB, what you call it is. So basically, foreign currency convertible bonds is a hybrid instrument. It will be treated as a embedded derivative instrument. Basically, what is FCCB? FCCB says that after a certain point of time, part of the bonds or full bonds will get converted into equity. However, because it is FCCB, it is denominated in dollar or any other currency. So what happens is that when you deal with that, if you will convert that price of foreign currency which has to be converted into Indian rupee, it will be a different price because of the foreign currency movement. So the international accounting standard, how FCCB is dealt with, is in two ways. One is that which we have to deal with even in case of a convertible debenture or a convertible preferences in future when Ind AS comes. What they say is that you remove the date portion, and that date portion you treat it as a date. The balance one you treat it as an equity. Okay, and then accordingly you deal with that. Now in FCCB, because generally there are options to convert and not a compulsory conversion, so there is another element which comes, which is the option pricing, and that is where, though it is an equity, it has an element of a derivative also. So that derivative portion needs to be separated, and then how that needs to be dealt with. So basically our standard says that you deal with as an embedded derivatives, which is there in the financial instrument standard internationally also. Only one difference which they have allowed is that you can treat it as an equity as per international standards only if it is the fixed shares to be issued at a fixed rate. So what generally it is called in international is fixed to fix. Fixed shares to be issued at a fixed rate, right? If there are number of shares to be issued is not defined, although rate is fixed, you cannot treat it as an equity. Other way around, the fixed shares needs to be issued per instrument, but the rate is not decided, then also you cannot say that it is an equity instrument. But in FCCB, so there was an argument that because it will get converted, $10 will get converted into 50 cents, let's say. We don't know what will be the $10 at the time of conversion. What will be the rupee equivalent of $10 at the time of conversion. And that is why it is not a fixed to fix in Indian rupee. And that is why you cannot treat it as an equity. And that is where our carve-out allows that if even in a foreign currency term it is fixed, it can be treated as an equity. So there will be implication of that. How you will deal with that, deal with the exchange difference, which will arise on the day when FCCBs are issued and on the day when it gets converted. So there is a guidance for that. Yeah. Sure. Then on employees' benefit, I think we have dealt with earlier also. There is only one change on that actual gain or losses. There is another one which is a smaller one, is that what yield you need to apply when you discount what is the future obligation. So it says that here only government bonds, not a corporate bonds.
Sir, in this employee benefits, so the rate of interest plays a big role in estimating the liability. And like exchange rate, the interest rates are highly flexible, and there is a huge gap between the interest rate is available in India, in abroad, interest rate.
So that is why what has been allowed internationally is that you can treat this difference which arises on account of this exchange, on account of the interest rate, that is actual gain or loss. So that you can take it to the reserves. So that's a difference.
Excuse me, sir. Sir, in that financial instruments, you had mentioned that classification into debt or equity. And if it is classified as debt, then it will be treated as financial liability the way we have it under AS 30. And you have that classification.
You will mostly have an amortization, and then it will be interest charge.
Okay.
So you have to work out the yield, and on that basis you have to take the charge.
Thank you.
fair value of financial instruments. Here it's interesting that what IFRS says is that if you have a liability, so if you have, let's say, issued your debentures, and because of your credit rating going down, there will be a change in the value of your debentures if you are not using the amortization method. So what it says is that your debenture values, your liability will go down with your reduction in your credit rating. So because you are not doing well, somebody will come and settle at a lower amount. So that is why there is a change in the fair value of the liability, and then liability gets reduced. Because of your deterioration in your quality of your company, then your liability gets reduced. So that is what has not been accepted in India, and they are saying that that should not be done.
So just one more clarification. That FCCB or this convertible instruments, you mentioned that the base instrument that you have to first decide whether it will be classified as debt or equity, and then that embedded one you have to split it up.
Correct. Yeah, see, FCCB, definitely there is no doubt that it has a debt element. So that has to be removed, and after that only we need to deal with that it is embedded element.
Okay, and then that embedded portion again,
it will be divided into option and equity. So one has to be dealt with as a financial, as a derivative instrument. Another one will have to be dealt with as an equity. Okay, we can, yeah, we can take it later. Business combination. Here also, rightly so, we have dealt with the carve-out. What they say is that if there is a bargain purchase, if you have acquired a company where the fair value is, let's say, 100, but you have acquired for whatever reason, because there is a distress selling by other person at 80 rupees, 20 rupees you book it as income. Because you have a bargain purchase, so you have gained on day one 20 rupees. So what actually our standard says is that you don't book it as income, you take it to the capital reserve. That is what is the change. First time adoption, I think we will just keep that, because first time adoption there are a lot of changes, but when the first time adoption will come, it will all depend upon that, because if there are other accounting standards, then that also will have to be dealt with. The only one thing is that when first time we will adopt, there will be a major change in the fixed assets. So what basically the international accounting standard says is that fixed asset also you need to reevaluate on the basis that if you would have followed IFRS at that point of time, what would have been the value today. So that is very difficult. So we have a concept of dim cost exemption. So what they say is that whatever is the carrying value, you take it as a dim cost, and then later on you deal with that as per IFRS. So that is another major actually relief when we will introduce new standard. Okay, moving to what is there now in Companies Act. If you look at it, the Companies Act has facilitated major change by way of a consolidated financial statements. Today, if you look at it, the SEBI only says that consolidated financial statements is mandatory. So it is only for a listed company. So now, because it is introduced in the Companies Act itself, consolidation will become mandatory for all the companies, which has either subsidiaries or associates or a JV. The confusion is that even if you do not have a subsidiary, whether you need to have a consolidation or not. As per the present Companies Act, unless they clarify, up to yesterday they have not clarified that. But what they say is that your associates and JVs also for a consolidation purpose, it will be considered as a subsidiary. So you need to consolidate. So if you do not have any subsidiary but only associates, you need to have a consolidation. So that is what basically it says. Another major change is in the definition of the control. Here, as it has been mentioned, that present AS 21 gives only two way of considering whether it is a subsidiary or not. Whether you are holding more than 50%, if you are holding more than 50%, it is a subsidiary. Or you have a control over the governing body. So in case of a companies, it will be directors. So if you have control over the board, then it will become a subsidiary. Now IFRS doesn't have on 50% ownership. IFRS says that whether you are controlling the decision making or you will be able to control a decision making which has been taken by the entities or not, and whether you are getting a reward out of that. So it means that you need to have equity in that, in any form, but you need to have the equity interest in that. So that is what basically it says. Now if you come out, now look at the Companies Act. The Companies Act definition says, which is there as a third bullet, right to appoint majority directors. So that is fine. If you have a right to appoint, there is no problem on that. Control over management policy or decisions. That is also not in line with today's our accounting standards, but it will become in line with IFRS.
So what is the meaning of control? You see, particularly in the JET SER deal, and there are so many such shareholders agreements, that even if a foreign shareholder is having 25 or 26%.
So as per the new Companies Act,
so
that is what I am saying, as per the new Companies Act, means as per the Companies Act 2014, we should not call it as new now, 1956 has become old. So as per the Companies Act, that will be, SER will be under control, because of the shareholders agreement and whatever other agreements. So here also, it deals with that control via management rights or other agreements. So it will exactly come into that. So that is what is a controversy, and that is where Jet Airways was interested in completing this merger or whatever this before 31st March. Somehow it has not happened, so we'll see that now how it will be applied.
So shareholding or board of directors control is no longer the sole criteria.
It's not the sole criteria, absolutely. And a control over 50%. And then, as I was mentioning, that JVs and associates also will trigger a consolidation. Another change which in the Companies Act, the major change is that Companies Act is saying that whenever there is a particular accounting standards which is applicable, then the provisions of that accounting standards will be applied if it is not in line with the Companies Act. That's one good thing which has come. In fact, up till now, as per the old Companies Act, it is other way around. In our framework also, we say that if there is a statute and rules, then statute and rules will prevail over the accounting standards. Now they have clearly come out with that if there is an accounting standard which you need to deal with, the accounting standard provisions will prevail over the act. So what happens? Although subsidiaries includes associates and JV, when you need to consolidate, but when you come for a consolidation, you will apply the standard which are applicable. So there is a separate standard of how to account for associates, because it will not be a line by line consolidation, only a pure subsidiary. As per the definition of an accounting standard, if it is a subsidiary, then only there will be a line by line consolidation. If it is an associate, as per the accounting standard, then there will be equity method consolidation. So that is one good thing which is there, and that is how it needs to be followed.
So if it is a joint venture or it's an associate, we have to do the consolidation, but by the method of AS27 or
Absolutely.
AS20.
Absolutely. That's it.
So, but in AS20 it is written that if there is subsidiary, then only you have to do the consolidation. So with that line, can we?
Yeah. So that is what. Only for accounting you can use the accounting standard. Okay. So here when it says that if there is an associate also, you need to consolidate. There is no accounting involved, so you need to consolidate. And then when you are applying the accounting, you need to go through the standard. So that is one thing. Second is that in certain cases you may not have equity interest, but as per the agreement you will be controlling this controlling the company. Take a case where there is a hotel company. You have given a management contract to ITC or Oberoi or any other franchise. Actually, full operations they will be controlling. So one can say that there is a control over all the decision making, and that is why it needs to be consolidated. As per the Companies Act, then it needs to be consolidated. Now, when you will apply a consolidation, there is nothing to consolidate because you do not have any equity interest. So what you will consolidate? So in such cases, it will happen that standalone and consolidated will be same, because you have a 0% equity interest. You have an interest in the profit, because in most of these franchisee cases, you will have 10%, 20% coming by way of a profit to you. But for a consolidation, it is very difficult. So that may be the case. I think the only option there is that in a standalone, you prepare standalone and you write that the consolidated accounting standards are also same. So that is the only way that it may have to be done. Another major change which is explained here is by way of considering the 50% interest. At present, we are considering 50% of equity interest. As per IFRS also, it will be 50% of equity interest. However, here they are talking about, Companies Act is talking about